Afternoon all. Thank you very much for joining us this afternoon, where we'll hear from Lisa Yang and Scott Malatesta, part of the management team behind BlackRock's Sustainable American Income Trust. We also have Kyle Caldwell from our friends at Interactive Investor, who'll be coordinating the Q&A session at the end of the main presentation. Please, could you use the Q&A function on your screen at the bottom right-hand corner to ask any questions you have, and we'll try and answer as many as we can at the end. We're going to have around 25 minutes of presentation and then loads of time for questions at the end. BlackRock Sustainable American Income changed its mandate in July 2021 and is now a dedicated value strategy with an explicit sustainability objective. Despite the new focus on sustainability, the team have not altered their commitment to investing in the highest quality opportunities within America's value stocks. So without further ado, I'll hand you over to the managers.
Great. Thank you, William. Good afternoon, everyone. This is Scott Malatesta. I'm going to start with a quick review of the BlackRock Sustainable Income Trust and then turn it over to the portfolio manager, Lisa, to walk you through some finer details. So the first page is, as William pointed out, we did change the mandate of the trust in July. I think it's very important to talk about what hasn't changed. And as you can see, the things that haven't changed are, one, the investment team. Our U.S. income and value team that is responsible for an excess of $65 billion is still responsible for this vehicle. The exposure within the trust, which is predominantly U.S. equities, that has not changed. Our belief that preserving the value investment style, as William mentioned, with a specific focus on dividend-paying stocks also remains unchanged. And then finally, we continue to target an attractive level of income for our shareholder base with long-term capital appreciation. So all of those things are still very tried and true for this strategy. What's been enhanced is that, to William's point, we have evolved the strategy to have specific performance and sustainability objectives. We've also transitioned the portfolio to a multi-cap strategy that will give our shareholders more meaningful exposure to mid-cap stocks. We've concentrated the portfolio holding range a little further. So we had been 80 to 120 stocks. Today, we are 30 to 60. Obviously, we use gearing in this portfolio. We have a neutral level of gearing of 5%. That will be in place in most circumstances. Today, it is somewhere just around 3% on its way to the neutral level of 5%. And then it will not exceed a 10% level. One of the things we have done is we've done away with the systematic use of an active options overlay, which was something that was in our prior iteration of this trust. And then we have also lowered the fee by 5 basis points per year. So if you turn to the next page, you'll see our investment team. So Tony DeSpirito, who's been on the trust since we launched it, David Zhao, Lisa Yang, a member of the investment team. Again, this is a vehicle that has dual client objectives. We're looking to deliver outperformance as well as ESG performance with ESG-specific deliverables. We're going to achieve that through the combination of attractive levels of current income with capital appreciation over the long term, delivering that premium ESG score and lower carbon emissions intensity. That's going to be versus the benchmark using MSCI data. And then we actively engage with company management teams of investments that we own, focused on helping them improve their ESG practices to promote more sustainable returns. So if you look to the right-hand side, information that you're probably all familiar with already, it is an investment trust. It is in North America. Its objective is income and capital appreciation, multi-cap value, as I mentioned, a little more concentrated with 30 to 60 holdings. The benchmark has been, continues to be, the Russell 1000 Value Index. And then some very specific ESG objectives. We want to have carbon intensity below the benchmark, and we want to have premium ESG, individual E, S, and G scores, as well as an overall ESG score that is higher than the benchmark. These, in this instance, these will all be relative to MSCI scores. There are some exclusions. that we will adhere to. One are baseline BlackRock EMEA screens. The others are issuers that we deem to be violators of UN agreements, global compact principles, and companies that just fail the SFDR good governance requirement. And then you can see that market cap spectrum below. So if you turn to the next page, this will give you just a touch on the investment philosophy. I'm going to spend just a moment here before I turn it over to Lisa. Just as a reminder for those, this vehicle is part of the U.S. fundamental equity business at BlackRock. It sits on the left-hand side of this chart, if you will, under the income and value pillar. That is headed up by Tony DeSpirito, who you saw on a prior page, the director of research for that pillar. One of the directors is David Zhao, and then Lisa, who's going to spend the rest of the time with you, is one of our senior portfolio managers and responsible with the other individuals for this vehicle. There's a number of strategies on the U.S. income and value side. Again, it totals just about $65 billion in assets. But what's really important on this page is also when you look at the right-hand side and you look down below and you see the other resources at BlackRock, hopefully as you've all come to know the depth and breadth of our organization. But what this shows is the amount of resources that Lisa and her team have to leverage. So talking to our growth counterparts, talking to our counterparts in our health sciences vehicle or our technology vehicle. And what this doesn't encapsulate is also the vast resources on the risk side, on the fixed income side. So the taxable fixed income counterparts that we have that we can lean into and talk to them about what's going on within their portfolios, and our multi-asset income team that we can talk to about what's going on in their portfolios. So just a wealth of information that we have access to that at the end of the day, we're very confident as you look at that bottom, will give us the opportunity to have a very strong analyst team with unlimited resources and the potential to deliver for you and for your clients enhanced investment performance. If you turn to page 6, I will pause here and turn it over to Lisa. This is a deeper view of our investment team, but we'll walk you through this very quickly. And then again, as was highlighted in the beginning by William, we certainly be more than happy to take whatever questions are on your mind. So Lisa, over to you.
Thank you, Scott, so much. I'm very excited to talk to all of you today about the BlackRock Sustainable American Income Trust. On this slide, you can see an overview of our team headed up again by Tony DeSpirito, who has decades of experience investing. I think what's important to note here are, in the yellow boxes, our team is divided up into sector research analysts, and you will see that under those yellow boxes, there are many names. Most have 4 or 5 names under those yellow boxes, and that is an illustration of how robust the research team is, and also it provides duplication of resources in case there is turnover on the team. And so you can see that there are a lot of people on the research side. We also have a lot of folks on the quant team and the risk side. And we also work closely with our internal BlackRock Sustainable Investing team. They sit separately, but we engage with them a lot. I'll also run through the investment philosophy. So this fund has a dual objective of delivering alpha and superior ESG outcomes. We think the best way to do that is through deep fundamental research and ESG analysis. And the ultimate goal here is to build a high conviction portfolio of attractively priced, high quality dividend paying US stocks. We think about the portfolio in 3 ESG groups, and that's ESG leaders, ESG improvers, and ESG enablers. The first bucket, ESG leaders, that's pretty straightforward. These are companies with the best ESG profiles within their sector, and the majority of our portfolio is invested in these ESG leaders. The second group are ESG improvers. These are companies that currently have average or below average ESG profiles, but where we think there's opportunity for improvement. This is often where we find interesting underappreciated opportunities. A past example of this is traditional US auto manufacturers, where for a long time, the EV opportunity was undervalued. The third and smallest group is ESG enablers. These are companies that are directly enabling the transition to net zero. If you look on the next page, this page and the page after this, it details our investment process. And the investment process is very thorough. It starts with idea generation, and idea generation can come from three different sources. First are our sector analysts. Their sector analysts are the industry experts. They really know what's happening on the ground with the companies. The second are our proprietary quant screens. Now, these are built by our internal quant team. And then the last source are our portfolio managers, who tend to have a breadth of knowledge about the markets. We then collect all of these ideas and they get prioritized into a research pipeline. And then the research analyst goes to work leveraging the broad range of resources that Scott talked about earlier. Over the course of this due diligence process, the analysts will talk to not only the company, but competitors, suppliers, customers, and ESG research vendors. It is really a very thorough research process by design. The end product is an investment presentation and recommendation that takes place at one of our weekly investment reviews, after which we will debate the stock at hand. This then feeds into a portfolio of 30 to 60 attractively valued stocks focused on the US market with premium ESG characteristics. Page 9 lays out all of this in a bit more detail. I won't repeat everything, but I will reiterate that this portfolio does have the capacity to take on leverage anywhere from a 0 to 10% range. Page 10 again highlights our dual objective, which is for both alpha generation and premium ESG trades. This next page, page 11, maps out the sustainability characteristics of the fund. So I will run through this in a bit of detail. So first and foremost, the portfolio has a premium ESG score as measured by MSCI, in addition to superior individual environmental, social, and governance scores. Second, there are certain ESG exclusions, and you can see them listed out here. They include tobacco, controversial weapons, civilian firearms, and coal companies. Our climate objective includes two factors. The first is lower carbon emissions intensity and higher exposure to companies committed to SBTI. Now, SBTI is Science-Based Targeting Initiative. This is a nonprofit organization that companies can commit to, and SBTI will evaluate that company's climate plan to see if it's aligned with net zero goals. Lastly, we also engage with companies, especially those who have below average ESG profiles. And we often do so in partnership with BlackRock's investment stewardship group. This is an internal group that regularly engages with companies. And the goal of these engagements is to better understand the company's key ESG factors, understand what their targets are, how they plan to get there, and then most importantly, track how the companies are performing against those targets. Moving on to the positioning of the portfolio, this page shows a snapshot of what the portfolio looked like as of the end of last year. The notable sector overweights are financials, tech, and consumer discretionary. Notable underweight sectors are industrials, consumer staples, and real estate. You can see the top 10 holdings on the bottom left. These consist of companies across industries and consist of a blend of ESG leaders and ESG improvers. The bottom right shows the key portfolio characteristics. You can see the dividend yield. You can see that the portfolio has a superior ESG profile. This fund has a 15% premium ESG score versus the benchmark, and it has a superior carbon footprint. You can see that it generates 50% lower carbon emissions versus the benchmark. The next two pages, pages 14 and 15, show the trust's historical performance. I want to take this chance to remind everyone that the new mandate for this fund, which Scott outlined, started in July of last year. The current portfolio was constructed from scratch. There was about 60% turnover versus the prior portfolio. Therefore, we think that the historical performance is not informative of what the current fund can deliver. And that's especially the case because the fund used to have an options overlay. This was meant to offer more income, but it capped upside exposure. And it was also a persistent drag on performance. Now, this new fund has gotten rid of the options component. We've also added the ESG mandate, and we've made this a higher conviction portfolio. We are encouraged by the results we've seen since the transition. Through the end of February, the fund has outperformed the benchmark by 350 basis points. Now I'll talk a bit about the markets before I turn it back to Kyle. So on page 16, you can see some of our macro observations. We believe we're going through a regime change. We think that the next few years will be very different from the 10 years we saw after the great financial crisis, where rates were low, inflation was low, and economic growth was low. We are now in an environment where both consumer and corporate balance sheets are very healthy, and both rates and inflation are rising. We think that this requires a different investment strategy. And this is why we're constructive on value stocks. Now, our quant team has done a lot of work on this, and they found that value historically outperforms in a rising rate and rising inflation environment, which is what we're experiencing now. Now, what's the intuition for that? Well, a lot of traditional value sectors benefit from higher rates and higher inflation. Take financial companies. They make money from higher rates and from steepening yield curves. Take energy companies. They benefit directly from rising commodity prices. It's also important to note that rising rates hurt growth stocks. If most of a company's earnings are in the future and your discount rate is going up, then naturally the net present value of those cash flows comes down. So within this context of rising rates and rising inflation, we are really excited about the changes we've made to the BlackRock Sustainable American Income Trust. We think it's a compelling and differentiated offering. Most funds that are focused on sustainability have strong growth biases, and that's because growth companies tend to be rated highly on sustainability. This fund does something different. It offers unique exposure to value stocks in the US with a healthy dividend yield and superior ESG traits. I'll end the presentation there and turn it over to Kyle for any questions that the audience has.
Thank you, Lisa. Hi, everyone. I'm Kyle Corbell. I'm the Collectives Editor at Interactive Investor, and I'll be moderating the Q&A. So if you would like to ask a question, then please put it in the Q&A box, and I'll try my best to get to it in the time that we have for the Q&A. So, Lisa, I just want to start off by asking, you mentioned in the presentation that the portfolio is now more concentrated, holding 30 to 60 shares, and that since last July, the turnover has been around 60%. What's your sort of assessment of that turnover level? Did it surprise you that the portfolio needed to be changed that much?
Yeah, so let me clarify that. So the turnover, the 60% turnover refers to the post-transition portfolio versus the pre-transition portfolio. As I mentioned, we built this portfolio from scratch because the mandate changed so much. We changed to the dual mandate of both alpha and ESG outperformance. We broadened the investment universe to mid-cap names. We concentrated the portfolio down to a fewer number of names. And so the way we did this was we took a blank sheet of paper and really rebuilt the portfolio from scratch, still leveraging, obviously, the research resources that the team already had. The portfolio turnover since the transition has actually been around 80%. Now that's higher than normal, but the market conditions have also been pretty different over the last, call it 6-9 months. In some cases, we're seeing investment theses for some of our holdings play out a lot faster sometimes in months, when in the past they would have played out in years. And conversely, we're seeing that the market volatility has resulted in some stocks getting punished a lot more than the fundamentals justify. And those have been good buying opportunities for us. And so the turnover is a bit higher than we would normally expect for this portfolio, but I think it is an indicator of the market conditions we're currently operating in.
The next question is regarding the dividend yield. The dividend yield is just over 4%. Does this show that you can invest ethically and generate an income, particularly when certain high-yielding sectors, the likes of miners and oil companies, may not be in your investment universe?
Yeah, let me clarify on the dividend yield. So the dividend yield on the portfolio is 1.8%. Let me just scroll back to that slide that showed that. So the dividend yield on the portfolio is 1.8%. The benefit of the trust is that we use the investment trust structure to pay an enhanced yield of 4%, which is a very attractive income level. This essentially allows us, the portfolio management team, to focus on the fundamentals of stocks and building the best portfolio without having to worry about delivering that level of income. On the second part of the question regarding investing in ESG and generating income, we're investing in companies in those sectors that offer the biggest ESG improvement opportunities. We believe that one of the biggest impacts we can have is towards achieving net zero is to get the sending companies to improve their emissions profile. I think the events of the last few months with the energy crisis have demonstrated the difficulties of this energy transition and highlight that traditional commodity companies still require financing if we are to have a successful energy transition. But again, we are more focused on investing in those companies that can improve their carbon emissions intensity.
And we've had another question related to the yield. So the 4% enhanced yield, is that a target? And is it intended to be progressive in nature?
I might pass this question on to Scott. If Scott, I don't know if you want to take this one.
Sure. Thanks, Lisa. So under the old structure of the trust, it was a target of 4% that was distributed. Part of that was achievable because we had the options strategy that was a component of the trust. When you eliminate that, there is some sacrifice, if you will, to yield. So while it is something that we strive for, it is not a progressive step, so to speak. So there's been a slight change to the income because you're generating less in income today from the underlying equities than we were, and you no longer have the options component to help offset that.
The next question relates to the big US tech giants. And you can see from the top 10 holdings that none of the big US tech giants are in the portfolio. Is this due to their lack of dividends or for ethical reasons or both?
Yeah, it's a combination of both factors. Most big tech companies don't pay dividends because they are either reinvesting back into the business for growth or they are buying back shares opportunistically. So they don't have the income component that we like to see. Some big tech companies also have very poor ESG profiles, especially on the social front. Now, if you look at the sector weights, you can see we're still overweight tech. We think this is a very attractive industry with a strong growth profile and high returns on capital. We've just chosen to invest in those tech stocks that are more attractively valued and offer the level of income we like to see for our investors.
And just moving back to there's another question on the enhanced yield. Hopefully able to be answered. The question is, so if the portfolio naturally yields 1.8% and the trust is committing to pay 4%, how is the 2.2% difference obtained? Is this coming out of realized capital gains?
Do you want to take that again, Scott? Or
Yep. Yeah. So some of it does come out of capital gains, but it is supported through a combination of revenue that's generated and then distributable reserves. So that's how you get to the 4% target.
The next question is a question that's quite specific stock question related to one of the top 10 holdings, and it asks, why would AstraZeneca feature as such a large holding in this portfolio?
So I probably can't talk too much about individual stocks. Can the question be made broader? Is it around the fact that it's not a U.S. stock? Maybe I'll talk a bit about that.
Yeah, because obviously around 15% of the portfolio is in non-US stocks, and I think the trust can go up to 25%. If you could run through why that's the case.
Yeah, absolutely. So I think it's important to understand that these are multinational global companies that we're invested in that happen to be listed outside of the US. We're not investing in, Italian utilities. And you can see that if you look at the top 10 holdings, along with Astra, there's another company that's not listed in the US, but their operations are very much global in nature. And from a research perspective, our team covers companies globally because these markets are often global in nature. You take, energy markets as a prime example of that. So it's paramount for us to understand the industry and the competitive landscape from a global point of view. And in doing that, sometimes we find that multinationals that are listed outside of the US are more attractively valued, are more compelling investment opportunities than their US counterparts. And lastly, I will note that the fund is capped in its non-US listed exposure. So the vast majority of the portfolio is still invested in US listed businesses. The ones that don't are primarily in global multinational companies.
We have a macro question related to inflation, which asks, how is the trust likely to perform in an inflationary environment? And will you have to change your strategy to increase the yield in that environment?
So I think based on the work that we've done looking at decades of historical performance in different environments, high inflation, high rates, low inflation, low rates, what we have found is that in rising inflation, rising rate environments, that value strategies tend to do well. And that goes back to some of the reasons I listed before, but traditional value sectors such as financial companies and energy companies directly benefit from rising inflation and rising rates. And then conversely, growth companies, which have more of their cash flow and earnings generation in outer years, will underperform versus value. So in an inflationary environment, we expect this fund to perform well. I don't think we would necessarily need to change the strategy in order to achieve a similar yield to what we're seeing now.
Another inflation question asks, how entrenched do you think inflation actually is and its long-term impacts? And also, for the benefit of our non-American listeners, how do you feel that the Federal Reserve will still need to be more accommodative in order to see genuine earnings increases across the US, especially considering their apparently increasing focus on low earners?
Yeah, let me cover the first question on how entrenched is inflation. We think it is very entrenched. Our energy analyst, who has covered the space for over a decade, he is very bullish on energy companies and energy stocks. His view is that energy companies have undergone, the last 7-8 years have essentially been a recession for energy companies, with oil prices crashing down from over $100 to, at the lows of COVID. These companies are now primed to not invest, despite the fact that prices are as high as they are now. What the energy companies are hearing from shareholders is do not invest. optimize cash flows and returns to shareholders. And so we think that the demand supply situation in energy remains very tight. Then you think about what has happened with the Russia-Ukraine conflict. They are a huge exporter of not only energy, but a lot of agricultural commodities. And so we see inflation across the board, across all of the agricultural commodities. And there's really no easy solution towards addressing the supply side of that equation. So we think from both a fuel and energy and agricultural point of view, we see inflation lasting. And then if you think a bit further out, the world requires a lot of investments to transition to net zero, be it renewable generation or electric vehicles. We believe those will all be inflationary. So you think about key commodity inputs that go into creating an electric vehicle. It will be inflationary for a lot of commodities. So we really don't see this. We don't see this as transitory as the US government officials had deemed it for so long. The second question was on the Fed and I guess Fed policy. I think originally the Fed wanted to stoke inflation. They had moved towards a policy of average inflation targeting. However, inflation ended up being a lot higher than they were even expecting. Obviously, I think the conflict that has come up in Russia and Ukraine makes their decision much harder, but inflation in the US is running high single digits. That is a really high level. And I think it is inevitable that the Fed needs to raise rates. It's simply, the question is really how much and how fast do they do that?
The next question asks, could you talk us through the decision to abandon the call options overlay and its implications for the trust's performance characteristics?
I might,
Yeah,
I might turn that over to
I'll
Scott.
take it, Lisa. Sure. So when we launched the trust back in 2012, it had a options component that was designed in large part to help achieve a higher distribution of 4%. One of the things option strategies do, just for those that may not be familiar, right? They obviously help generate additional income for the strategy, and they provide some element of downside protection. So in theory, if the market is declining and you have an options override strategy in place, it's going to limit the downside participation to a certain extent. But by the same token, it's going to limit the upside participation too when the market is moving higher. And so after a lot of discussion with shareholders, with the board of the trust, with our partners, both internally and externally at the firm, our conclusion was we were better served, and our shareholders, most importantly, would be better served if we did away with the options component and had the trust not have that particular element to it, and then really manage it, deliver the income. As we stated, some of that income comes out of reserves and revenue generated, and then change the structure of the trust to focus much more on what's really important to shareholders today and will continue to be of sustainability characteristics, and moving the trust to a degree down in capitalization to offering more of a multi-cap value vehicle. So those were all the things that went into that decision that we made to eliminate the options component.
The next question asks, how actively will a trust use gearing? Having not used it before, do you tend to will you use it opportunistically?
Yeah, so the trust gearing can range anywhere from 0 to 10%, and obviously will fluctuate depending on where we think the markets are going. And the neutral level is viewed as 5%. So we will tend to be around 5%, and then depending on whether or not we're more bullish or bearish on the markets, it could be higher or lower than that 5% neutral level.
And we have a couple of ESG questions. And first off, could you explain how you actively engage with company management on ESG issues?
Yeah, so we work in partnership with our internal BlackRock investment stewardship group, and this is an internal group that we have at BlackRock that regularly communicates with companies about corporate governance issues. And so they are really the internal experts on this front. And as I mentioned in the presentation, the ESG engagements are often focused on those companies that have below average ESG profiles. And these engagement meetings are really focused on understanding the company's key ESG drivers, what their goals are, and then what they're doing to try to achieve those goals. And then, we will have regular conversations with these companies to see how they're tracking against performance on these ESG goals. But it is, it's an ongoing conversation, and we really do want to see that these companies we're invested in, especially those that score below average on ESG, have tangible improvement plans and goals that they are making progress on.
Lisa, you ran through in the presentation the 3 types of sort of buckets: the ESG leaders, ESG enablers, and ESG improvers. You mentioned that the portfolio has the most at the moment in the ESG leaders. Will that always be the case?
Yeah, I think that will usually be the case, given our mandate is dual in nature. It's our dual mandate is ESG outperformance and alpha generation. So by the nature of having a premium ESG score on our portfolio, we will tend to own more of the ESG leaders in order to achieve a premium ESG profile for the portfolio overall.
And the next ESG question says the Ukraine crisis is having a profound effect on the discussion around ESG, with the evils of resource scarcity and spending being revisited in light of the conflict. Do you think this will have any lasting impact on how ESG metrics are calculated? But more importantly, how do you think this will have differing effects on growth stock ESG and value stock ESG, as value investing seems on the surface to be the net winner in the current markets, for lack of a better term?
Yeah, I think the crisis highlights, I think I kind of mentioned this earlier, but the energy transition is perhaps more difficult than what we had perceived, and the move, especially in Europe, to transition very quickly to renewables and shut down more traditional sources of energy had led to a dependence on Russia for its energy needs. And I think it does emphasize the fact that we do need to be more thoughtful in how we conduct this energy transition. I do think we could see the possibility of more nuclear energy being used as an example, and more LNG being used in Europe, and more traditional fossil fuels being used, while also deploying more capital into renewables. I think we can't go from 0 to 100 within the blink of an eye. It really does take time, and traditional commodity industries still need financing and capital while we are making this transition. It also brings up an interesting question around defense, with the move in Germany to take up defense spending to 2% of GDP, and kind of characterizing that as a pro-ESG move, which is, I think, interesting, and it'll be interesting to see what happens on the defense front broadly out of Europe.
And the final ESG question so far is asks, does ESG is ESG one of the reasons why the trust is permitted to invest up to 25% outside of the US? Is there not enough ESG compliant companies in the US to be of interest?
So no, that is not the reason why we have this 25% allowance for ex-US companies. I think it really goes back more to our research process. Our research analysts who are sector focused really cover companies on a global basis. And so they, the consumer analyst is looking at consumer companies in Europe, in US, really across the board. And a lot of the times these are multinational companies. So it's really, you can have a UK company that only derives a few percentage points of their revenues from the UK. And you can have a US listed company that has the majority of its revenues derived from outside of the US. So the way we think about it is, the research analysts cover companies and industries globally, and we often see interesting mispricings between US listed multinational companies and multinational companies that are listed outside of the US. And we want to take advantage of that opportunity. So having the 25% allocation or max allocation outside of the US allows us to take advantage of those mispricings.
There's a question that's a follow-up from a question you answered earlier regarding portfolio turnover since the mandate change. The question asks, for long-term holders of the trust, has there been any material change in its risk return profile or its style profile?
Sorry, what was that question again, Kyle?
So it asks, since the mandate change and the changes made to the portfolio, has there been any material change in its risk return or its style profile?
Yeah, this is Scott. I would say that from a risk return profile, there haven't been meaningful changes since we restructured the trust, but certainly from a style perspective, this is a different vehicle, right? It is now a sustainable product that has very specific, as Lisa discussed, ESG deliverables. It no longer has the options component to it, and it is going to be more multi-cap value. So from a style perspective, there are differences. Overall, if you were to look at the risk return targets that we spend a lot of time looking at with our a group that is referred to at BlackRock as RQA, which is our risk and quantitative analysis team. Extensive work has delivered the outcome that we don't believe there will be material differences in the risk return profile of the strategy, but certainly from a stylistic point of view and how shareholders may elect to allocate capital, the fact that this is a sustainable vehicle now is different than what it was prior to the transition.
So we've got two more questions, hopefully just be able to get through them. The first one goes back to inflation. It makes the point that a lot of quality growth arguments is around pricing power, but how do high quality value companies stack up? Is value better able to deal with price rises than growth?
Yeah, so I think a quality company across the style spectrum tends to have better pricing power. So, certain companies that don't have a lot of growth, but have high returns on capital and therefore are higher quality in nature often have pricing power. I wouldn't say that high quality value companies have any less pricing power. I think the differentiator in a high inflation environment is that for a growth company, naturally more of the company's earnings and free cash flow generation come from years that are, several decades out. And so simply when you do the math on a net present value, when the discount rate goes up on that, the net present value calculation for that company comes down just by doing the math of that NPV calculation. Whereas for a value company, more of its earnings and free cash flow are in the nearer term. And so when you do that calculation, there's less downside risk as interest rates go up. So I really don't think pricing power is differentiated on a growth versus value basis. It's differentiated on a high quality versus low quality basis.
And the final question, and it's been obviously a popular topic is the enhanced dividend yield. So the question asks, if the underlying portfolio yield remains around 1.8% and the trust is committed to pay 4%, if the underlying portfolio yield remains around 1.8%, and for the sake of argument, capital returns are flat, for how many years can a 4% yield be paid out of current distributable reserves?
I don't know if Scott, you want to take that question?
Yeah, Kyle, can you just repeat it, because I think we may have to come back to you for an answer on that one. I'm not sure we're going to be able to provide the answer in this venue.
Okay, no problem. I'll leave that. I'll hand back to Billy, and I'll leave that with him to pick up later on. Thank you.
Okay. Thank you.
Thank you, Scott, for your time. That concludes the Q&A.
Thank you so much.
I'd share the thanks to you guys, and also to Kyle for doing the Q&A. Thank you all for listening. This is a 3-day event. Tomorrow's kicks off with Aberdeen, China at 9 a.m. So if you'd like to join, there will be details on our website. Thank you so much again for dialing in, and thank you one more time to the BlackRock team. So thanks so much, and hopefully see you tomorrow.